Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I will be your host for about the next 20 minutes here, maybe 25, on Options Guide TV. So we had the huge kickoff, literally the kickoff of Black Friday, in that we also had a football game on Black Friday, the first one ever. So obviously Amazon sponsored that football game. I wonder how that all worked out. I'm pretty sure they planned that out appropriately. And so far, the numbers have been fairly strong, setting records again in sales on Black Friday. We had Cyber Monday, still getting some information from Cyber Monday, but the retail consumer continues to be strong. Seems like we are kind of kicked off a little bit of a rally going into the holidays, kind of hoping that we were going to get that Santa Claus rally, which usually ends up that's actually between Christmas and New Year's Eve. But we decided to get bullish on Monday's show on Options Guide TV. And probably, there's been some comments from the Fed in general. We have 14 days. That's the countdown until the next Fed meeting. But just one-off comments are kind of hinting to the fact that a rate cut could happen this year. If you look at the futures, we do see on the CME FedWatch tool that they are saying in March the probability of a Fed rate hike has increased now to over 30%. The highest that I had seen it was right around 25%. As a matter of fact, let me run over there right now and check it. I'm seeing in March, now they're showing that there is a 45% chance of a rate cut in March. That was 30% yesterday. And even a half a point is actually showing up. There's about a 2% chance of a half a point rate cut as opposed to, so that it's a chip in a chair that may happen, but only a 51% chance right now that they're going to keep the rates where it's at. So obviously that has been the main driver of the market. We're seeing the S&P 500 index today is up $17. The NASDAQ, the Russell, they're all up. Russell has actually made the strongest move. They're up about 1.3% on the day, where the NASDAQ is about 0.5%. And this has driven down the VIX index precipitously. That's trading around 1277, staying within that range or so. But the VIX is definitely on the low end of the range that we've seen in many years, down around that 12% range. I personally would rather have the VIX right around 15 to 20. I'd prefer trading in the SPX with a little bit higher VIX, which the VIX is a function of the S&P 500 index options. But with that said, we did a long call spread in the SPX, and it was a speculative trade. It was a 1 week trade. The options will not full 7 days, but from Monday to Friday. They're going to expire on December 1st, which is the first Friday in December. And the trade that we looked at doing, well, obviously is profitable at this point in time because we were bullish on it. Now, let's go back and review that trade. And then also here on Options Guide TV, we're going to come out and we're going to adjust our paper trading portfolio of deep in the money option contracts. We have a couple of covered calls that we have to sell against our positions. And so we're going to have to take a small break from the actual trading account. This is a test trading account where we're looking at the SPX, and we're going to have to move over and look at our paper trading portfolio. So with that said, let's run to the TradeHawk software right now. And inside the TradeHawk software, 1 second here, let me pull up my screen. I have the trade all set up that we had on Monday. S&P 500 index right now is at 45.69. If I look at that trade on Monday, 1 second, we saw that the market was right at 45.50, exactly at the money as the option contract that we sold. It was 45.50. We then went deeper in the money and bought the 45.40s. and we paid a net debit of $5.80 for that trade. As a matter of fact, the market continued on up, actually had a strong finish. So by the end of the day on Monday, we would have been up on the trade. But now that we're trading at 45.70, 45.60, yeah, we'll call it 45.70. We see that this at the midpoint now, we'll call it 47.50. Okay. So this is an interesting, that's where we're going to put our limit at. It's dancing all over the place there. This is where the actual midpoint is at. This is the debit. If we were going to undo the trade, we would obviously make this a sell, and I have to put to open because we don't actually have the position on in this account. And this would have to be a buy to open, and that would show you a net credit of 735. And I want to make that, yeah, we'll go 740. Okay. Not quite $2. Now, the max that the trade could be worth is $10. And we put it on for $5.80. So we were probably there for a minute where we were up about $2 on that trade. Now we're back down. It looks like $1.60 on the trade. So this would be a very important time to consider to get out of the trade. So on Wednesday, whenever I've done my long call SPX trade, Wednesday is always kind of my trade day, in that if the market does go down on Tuesday, set it up on Monday, remember, and if it goes down on Tuesday, I can adjust. I don't mind adjusting that trade. If it's flat, I'm not really going to do much, but from Wednesday to Thursday, you're going to see a large rate of decay in the SPX option contracts. And they hold their value pretty well all the way to the end of the day on Thursday. And then obviously on Friday, all that time value that's in any of the option contracts has to come out because we're approaching expiration. So if we look at the 45.50, here's our issue, is that on the extrinsic, looking on the TradeHawk software, we still have $12 of extrinsic value. So when you do a long call spread, we are long the 45.40s. That is working with us. We are short the 45.50s. That is working against us at this point in time. So in order for this to become maxed out, we need the time value out of this option contract to go away. So every day that goes away, the extrinsic value, this is going to become, the bottom line is if the market doesn't move at all, and all we get is time decay in this 45.50 option, our short option contract, it's going to start expanding and generally making its way towards that $10 mark, which is the width of the spread. Now, if it continues on up, what happens is that option contract gets deeper and deeper in the money. And as you go deeper and deeper in the money, and we'll highlight that by going up on the change, these strikes are deeper in the money than the 45.50. And you see the extrinsic value starts going down. So two ways that the spread can max out is that it gets so deep into money that the time value just dries up on both of the option contracts, or we just have time decay in general. Now, the danger is always that the market could start going down, and it looks like it's already moving against us right now. It's 725 where it was 740 before. And so if it does start going down and start going against us in this position, then that makes us nervous. Then we have to adjust the trade. So this is a very interesting point as to if you'd want to get out of the trade or if you'd want to stay in the trade. Now, I would probably ride this for the rest of the day. I feel like the market is strong, and you can you can look at whatever charts you want, look at your moving averages, look at your candles, look at whatever you want to try to make your determination. But I would probably close it out before the Thursday open. I'd give the rest of the day to get some time decay. There's no real reason. I'm up a couple of bucks on the trade. That's usually a solid outlook on it. We paid $5.80 for the trade. We obviously can't double, right? Because the maximum that it could trade for is $10. And to try to extract that last even 50 cents out of the trade is really hard to do. So I don't mind selling it now. I would probably sell it going into the close and not take the market open risk on Thursday because the trade is obviously profitable. And we had two different scenarios, right? We said that if we just get some time decay, when we put this long call spread on, the market was at 45.50. And that meant that if the market just stayed where it was at and we got some time decay, we could actually be profitable on the trade. The market worked with us. It ended up going up. And so at this point in time, that's where we're at. Now, ideally, if you want to learn more on Options Guy TV, it's a lot of times easier when the trade doesn't work out. If the trade didn't work out, we were going to roll into a butterfly trade. And we highlighted that on Monday. So I'm not going to go back into it again. If you want to, you can go back and review the tape from Monday's show and look at how we were going to adjust if the market would have went, and in this instance, we'll call it 10 points. It went down 10 points as opposed to up 10 points. If the market was somewhere down around the 45.25 range, right where the strike is that I'm highlighting, that's when I probably would have rolled this trade, or I would have added to the trade and made this an actual butterfly, took a credit into the account and removed some of the risk of the trade. Just that straightforward. Okay. So now I'm going to run over to the options playbook. So let me jump here for a second. And I'm going to have to close out this test account. And if you have any questions, this is a great time to put them in the chat box. And when we do that, then 1 second here, let me just close this. It's going to take me a second here. And I'm going to bring up the paper trading account. So this portfolio that we've been working on, I mentioned it in October that when we got to November, we started doing this at the end of October, but when we got to November, that we wanted to build a portfolio of deep in the money option contracts. I've never been able to do this on a webcast, so like to do it in a paper trading portfolio. Instead of buying long stock and trying to get long the market going into the holidays, we were going to use option contracts to do that. Kind of made sense in this environment, considering that people are still talking about a recession. Right now, the murmurs are soft landing, that the Fed is going to pull it off, all yada, yada, yada. So with that said, though, if we buy deep in the money options as an alternative to buying the stock, well, then you have limited and known risk on the downside. And if we were long stock right now, I would definitely be selling calls against it. So that's what we're going to do in our paper trading portfolio. So ideally, inside the options playbook, we have the strategy called the fig leaf. And so let me go here, and I'm going to pull up that strategy to start with. 1 second, and we'll highlight that strategy. Okay, so the fig leaf is so let's bring that up to start with. And give me 1 more second here to get situated so that I can get back to the paper trading portfolio. All right. All right, looking good. So inside the fig leaf, i.e. leverage covered call, I've heard it called a synthetic covered call, which is not correct, because synthetic means that you have the same risk. Or if it's a synthetic trade, that means it's the exact same risk profile. But with a fig leaf, you're buying a deep in the money option. So this right here actually cuts off because it's what you paid for it. You're paying a lot for that option contract, but you have limited and known downside. It's usually about 20% of what it would be to buy that stock outright. I wouldn't take all that risk. I would get out before I was down around 10%. I would probably take that trade off. And that usually means that it's came down towards that strike price, but it obviously matters what time period it takes for that to happen. Then you sell a call against it, and you got a little bit of a wavy line. Whenever you see wavy lines, it usually means in a profit and loss graph that there's different time expirations, which is the case. This would be at the expiration of the short call option. And this is the trade that we're doing, as opposed to just buying the stock outright and selling calls against it. We are looking at doing the fig leaf. All right, so now let's do one more time. Let's jump back to the main screen and let's bring up the TradeHawk software, and boom, 1 second. And now let's go and adjust our portfolio of deep in the money option contracts that we have. All right, so on going into the holiday, we looked at Google, and Google actually reached our strike price of our short call. So because of that, we rolled that position. Note that this goes out now to December 15th. We brought in a small net credit to the account, but we have mentioned many times on these call options, we really don't want to be assigned. We either want to close out the whole trade or we want to do something to adjust it. Google's been strong since we put it on. So we actually went and sold this call option against it to try to avoid an assignment on that Google position. Now in NVIDIA, we have one that is going to be expiring when our actual long call spread this Friday on December 1st. So after their earnings announcement, NVIDIA was the last of the Magnificent Seven to announce earnings. They had a little, actually incredible earnings, but the stock actually still sold off. We sold a call against that position. We're going to let that ride. We got 2 more days to do it. But if we go down to the Charles Schwab position here, we see that we only have our call option. Let's see where Schwab is at. It's not trading. SCHW. And this is the paper trading account, by the way, which is a totally different even though it looks a lot like a standard account that you would have actual capital in. This is the paper trading version of the TradeHawk software, and it is awesome to be able to test out these strategies using that software. So it's just like, it looks exactly like the real software. Okay, so Schwab is at 59. We own the 45 strike call on the position. We're up $400 on that position. So we are going to now go over to the options grid, click on that, put in Schwab, SCHW. By the way, the one thing about the paper trading portfolio, and part of the reason why we didn't start in it, is that you won't get quotes on big exchanges, things where you have to pay for quotes. It makes sense. SPX, Russell 2000 RUT, NDX, even the VIX, you cannot receive quotes on them. And you see that the VIX is quoting 0. That just means we're in the paper trading account. Okay, Schwab. Let's see how far we can go out. So we're going to go at least a 1 standard deviation move. I don't think there's going to be enough juice to do the December 8th contracts. Yeah, we do the 1 standard deviation. We're at 16 cents. So I think we'll do that, and we'll keep this one the same as our Google position, which is the 15th. All right, there we go. So that makes it easy. Now, I don't necessarily, that's not a standard rule, but if I like to try to keep these together if we can, but you have different earnings dates, you have different situations. So then I can come in on this expiration and adjust this trade. Hopefully they expire worthless, because that's our goal by doing this strategy. So if we go out to the 15th and we look at it, now we're at 26 cents on our 64 strike, and that delta is at 13%. I would like to sell the 63, but I'm going to lay down until the urge goes away. That's a decent amount of premium. I like that one better, but when I'm doing a fig leaf where I really don't want this thing to be assigned, I'm going to sacrifice premium to go a little bit further out of the money. Now, I don't mind the 29 by 27, so maybe we get filled right at, well, we'll hit the bid on 27. But I'm going to take a peek at the 23-day option contract. We're now in the 16-day option contract. I'm going to take a peek at the 23-day option contract. We're going to go a little bit further out of the money, and then we get up to 38. That's a 16 delta. And if we go a little bit higher down to the 12, we got 27 by 23, a little bit less tight of a market. 16, this is a 14 delta. That's really a tough one. So the probability is a little bit higher on this one. We're bringing in a little bit more premium. I think we're going to do the 15th. Let's do the 15th. We're going to stick with this, and we're going to sell this option contract against it, the 64 strike option. So we're going to hit the bid on this, 28. Let's just make it 27 so we can fill it on the show. And here we go. We are sending an order to sell a call on Charles Schwab, the 64 strike call with the expiration date, December 15th, 2023. We're going to send this to the floor at a limit price of 27 cents. And we hit yes, and boom. We should see over here in our events that we filled. Yes, we did. Sell one Schwab at that limit price, and we go back to our portfolio, and we see it inside our portfolio. 16 days to expiration. All these, by the way, notice they go out over 400 days, 415 days remaining. They were obviously longer when we put the trades on. Portfolio is doing strong. It's doing well so far. So do you have any questions at all on today's show? And if you do, I'll be happy to try to address them. All right. We have Matt. Matt says, QQQ, NASDAQ, bullish month ahead. Inflation cool, GDP positive. That is a fairly good summary, Matt, overall. Added the at 1885 high. Okay, crude oil fall upon inventory. All right, so just in general, Matt's just summarizing, and you can see it in the chat box what's kind of going on in the marketplace right now, and part of the reason why we're having a bullish month. I do think it really started with Home Depot's earnings. Home Depot in the middle of the retail earnings from a lot of companies. Home Depot came out strong, but they actually gave some guidance that was fairly weak. But Home Depot really skyrocketed after that, and then we had a smattering of retailers that had medium earnings. Nobody had horrible earnings. All the stocks either trickled upwards or kind of went down slowly. So we didn't have any of the major retailers, Target, Walmart, do anything that scared the marketplace. And so far, the numbers that we're seeing from the holiday sales over the weekend, once again, indicating that the retail consumer is strong, and they've really been our superhero throughout this entire economy. And the unemployment rate is going up slowly, which kind of makes the Fed happy and doesn't really seem to be killing a lot of the just retail consumers. Wages are going along with wages are increasing too, and they've stayed on a steady growth pattern. So geopolitical concerns are a big deal, obviously, and that's a landmine that anything can happen with. But going into this holiday season, it seems like we are fairly strong in the marketplace. We may come back on Monday and actually do another SPX long call. We'll do a few of those going into the Christmas holiday. One of the things that we do here on Options Guy TV is that we're trying to look at different market conditions that we can apply some of the 40 strategies that are inside my book, The Options Playbook. And this is one of the strategies. If I'm feeling bullish on the marketplace that I like to go to. It's one of my go-to strategies. It's on a weekly basis. Don't want to be around over the weekend. I'd really like the VIX to be up a little higher. I'd like to see the VIX around that 15% level, but then again, you get what you pay for. The VIX is down around that level because we've had a good, strong bullish market. Okay. So any other questions? No, I don't see any more. So that's it for this edition of Options Guide TV. Please click subscribe, ring the bell, pound that thumbs up. That will help us here out on Options Guide TV. And we'll see you this coming up Friday at 11 a.m. Eastern Time for the next edition of Options Guide TV. Thanks for coming, everyone.